Hey folks, welcome back to Boss Economics World, where we rip the band-aid off economic delusions, expose government incompetence, and serve you the raw, unfiltered truth about why your wallets are shrinking faster than a cheap suit in the rain. I'm your host, the no-nonsense, data-slinging, government-critiquing economist you didn't know you needed. And boy, do we have a doozy of a story today, a tale of ballooning debt, reckless spending, and a government that's driving the US economy straight into the ditch. So, buckle up, grab your calculators, and let's dive into the latest economic train wreck, Moody stripping the US of its last top credit rating. Spoiler alert, it's the government's fault, and you're paying the price. On Friday, May 16, 2025, Moody's Ratings finally pulled the trigger and downgraded the US credit rating from AAA to AA1, joining Fitch Ratings and S&P Global Ratings in kicking Uncle Sam off the AAA pedestal. That's right, folks, the world's biggest economy is no longer considered a top-tier borrower. And why? Because, according to Moody's, successive administrations and Congress have turned the US into a fiscal dumpster fire, with ballooning debt and deficits that show no signs of slowing down. Translation: your government is spending like a teenager with a stolen credit card, and now the bill's coming due. But wait, there's more. Just as Moody's dropped this bombshell, lawmakers in Washington were busy cooking up a massive tax and spending bill that's expected to add trillions to the federal debt over the next decade. I mean, talk about timing. It's like getting caught stealing cookies from the jar and then asking for a second jar to raid. And the markets? Oh, they noticed. Treasury yields on the 10-year note spiked to 4.49%, and an ETF tracking the S&P 500 dropped 0.6% in post-market trading. That's Wall Street's polite way of saying, what the heck are you clowns doing in Washington? Now, if you're an everyday Joe or Jane watching your savings erode under inflation, or a finance pro trying to navigate this mess, you're probably wondering, how did we get here, and why is the government to blame? Well, stick with me, because we're about to peel back the layers of this economic onion, and trust me, it's gonna make your eyes water. Let's start with the core issue: the US is drowning in debt. As of 2025, the federal debt has surpassed 100% of GDP, meaning the government owes more than the entire economy produces in a year. To put that in perspective, the Congressional Budget Office, CBO, warned in January 2025 that we're on track to hit 107% of GDP by 2029, a level not seen since the aftermath of World War II. And that's before factoring in the GOP's latest tax cut extravaganza, which could add another $3.8 trillion to the debt over the next decade, according to the Joint Committee on Taxation. But here's the kicker: this isn't just a numbers game. Higher debt means higher borrowing costs, especially when credit ratings tank. Moody's explicitly pointed to declining fiscal metrics as the reason for the downgrade, and they're not wrong. The federal budget deficit is running at nearly $2 trillion a year, over 6% of GDP. For context, the European Union considers a deficit of 3% of GDP to be excessive. We're double that, folks. And with Treasury yields climbing to 4.49%, the cost of servicing that debt is skyrocketing. In 2024, the US spent $659 billion just on interest payments, according to the Treasury Department. By 2035, Moody's predicts deficits will balloon to 9% of GDP, driven by rising interest payments, entitlement spending, and pitifully low revenue generation. Now, let's talk about who's to blame. The government, both parties, has been on a spending spree since the COVID-19 pandemic, borrowing like there's no tomorrow. Remember the $1.9 trillion American Rescue Plan in 2021? Or the $1 trillion Infrastructure Investment and Jobs Act? Sure, some of that was necessary, but a lot of it was pork barrel spending dressed up as stimulus. And now, with a global tariff war weakening the economy, the government's response is, surprise, more spending. It's like trying to fix a leaky dam by pouring more water into it. Speaking of spending, let's zoom in on that massive tax and spending bill Congress was debating on the very day of the downgrade. This monstrosity is set to extend provisions from the 2017 Tax Cuts and Jobs Act, which, by the way, already added $1.9 trillion to the debt, according to the CBO. The new bill's price tag? A cool $3.8 trillion over the next decade, though independent analysts say it could be much higher if temporary provisions get extended. And guess what? On May 16, 2025, a key House committee failed to advance the bill because even hardline conservatives were like, whoa, this is too expensive. When they're the voice of reason, you know we're in trouble. But here's the real scandal: this bill isn't about helping the average American. It's about political posturing and corporate handouts. The 2017 tax cuts disproportionately benefited the top 1%, with the Tax Policy Center estimating that 60% of the benefits went to the wealthiest households. Meanwhile, middle-class families got crumbs, and now inflation is eating those crumbs alive. The government's obsession with tax cuts without corresponding spending cuts is a recipe for disaster. Just look at the UK in 2022, when Liz Truss's unfunded tax cuts triggered a bond market meltdown and forced her resignation after 44 days. Are we heading for a similar fate? With Treasury yields spiking and investors demanding higher returns, it's not out of the question. Now, let's talk about what this downgrade means for you. When a country's credit rating drops, it's like your personal credit score tanking, lenders get nervous, and they charge you more to borrow. Tracy Chen from Brandywine Global Investment Management put it bluntly, the downgrade may indicate that investors will demand higher yields on treasuries. Higher yields mean higher borrowing costs for the government, which means less money for schools, roads, and healthcare, and more of your tax dollars going to Wall Street bondholders. But it's not just the government that suffers. Higher treasury yields push up borrowing costs across the economy. Mortgage rates, car loans, and business loans all get more expensive. In fact, the average 30-year mortgage rate in the U.S. hit 7.1% in April 2025, according to Freddie Mac, partly due to rising treasury yields. That's pricing millions of Americans out of the housing market. And businesses? They're already grappling with a global tariff war that's slowing growth. Higher borrowing costs are just another kick in the shins. And let's not forget the psychological impact. The US dollar and treasuries have long been considered the world's safe haven, but with all three major rating agencies downgrading the US, that status is in jeopardy. Just look at the market reaction, a 0.6% drop in the S&P 500 ETF signals investor jitters. If confidence in US assets erodes, we could see capital flight, a weaker dollar, and even higher inflation. Remember the 1970s, when the US lost its economic mojo and stagflation took hold? We're not there yet, but the parallels are eerie. Finally, let's zoom out to the big picture. This downgrade isn't just about today's mess, it's a warning about tomorrow's catastrophe. The CBO projects that federal spending on Social Security and Medicare will soar over the next 2 decades as baby boomers retire en masse. By 2040, these programs will account for 14% of GDP, up from 10% today. Add in higher interest payments on the debt, and you've got a fiscal tsunami on the horizon. But here's the infuriating part, lawmakers know this, and they're doing nothing. U.S. Treasury Secretary Scott Bessent admitted in May 2025 that the debt trajectory is unsustainable and warned of a potential sudden stop in the economy. Yet, instead of tackling entitlement reform or raising revenue, Congress is busy fighting over tax cuts and spending sprees. It's like rearranging deck chairs on the Titanic while the iceberg looms ahead. So, who's to blame for this mess? Spoiler alert, it's not you, it's not me, it's the clowns in Washington. Successive administrations, Democrat and Republican, have treated the federal budget like a personal piggy bank, doling out tax cuts and spending programs without a shred of fiscal discipline. The Biden administration's $1.9 trillion stimulus in 2021. A sugar high that fueled inflation. The Trump administration's $1.9 trillion tax cuts in 2017. A corporate giveaway that blew a hole in the budget. And now, with a global tariff war slowing growth, the government's response is, yep, you guessed it, more borrowing. But it's not just the executive branch. Congress is equally complicit, with its endless gridlock and refusal to tackle tough issues like entitlement reform. Remember the debt ceiling fiasco in 2023, when political brinkmanship nearly triggered a default? That's the kind of dysfunction that led Fitch to downgrade the US, and now Moody's has followed suit. And let's not forget the Federal Reserve, which kept interest rates at rock-bottom levels for years, encouraging the government to borrow like there's no tomorrow. Now, with rates rising, the bill is coming due, and guess who's paying it? You, the taxpayer. Here's the bottom line, folks, this downgrade is a wake-up call, but don't expect Washington to answer the phone. The government's reckless spending, obsession with tax cuts, and refusal to tackle long-term fiscal challenges are driving the U.S. economy toward a cliff. Higher borrowing costs, eroding investor confidence, and a potential fiscal crisis are all on the horizon. And who suffers? You, the hard-working American, watching your savings shrink, your mortgage rates soar, and your tax dollars vanish into the black hole of debt interest. So, what's the solution? First, Congress needs to get serious about fiscal discipline, cut wasteful spending, reform entitlements, and yes, raise revenue. Second, the Fed needs to stop enabling this madness by keeping rates artificially low. And third, we, the people, need to hold our leaders accountable. Because if we don't, the next downgrade won't just be a notch, it'll be a nosedive. That's all for today, folks. If you're as fed up as I am, smash that like button, subscribe, and share this video with everyone you know. Because here at Boss Economics World, we don't just report the news, we call out the nonsense. Until next time, keep your wallets tight and your government in check.